Welcome back to the deep dive. If you are preparing for the NISM Series 12, you know we've reached the absolute complex core of the certification.
We certainly have.
We are diving deep into Chapter 6, Derivatives Markets. This isn't just about defining terms.
Not at all.
This is about understanding the mechanics of risk transfer, financial engineering, and the highly specific regulatory norms that govern these high-stakes products in India.
That is absolutely correct. For the NASM certification, generic knowledge simply won't cut it. We are adopting the mindset of senior exam instructors today,
Right.
guiding you through the source material with surgical precision. Derivatives are fundamentally contracts designed to manage future uncertainty.
A tool for financial time travel, if you will.
That's a great way to put it. It allows you to lock in today a price that won't materialize until tomorrow. Our goal is comprehensive knowledge, prioritizing every single regulatory detail required for success.
And we have to acknowledge the central paradox of this deep dive right up front. We are meticulously studying a market that is flawlessly engineered for systemic risk management. I mean, the exchanges guarantee every single settlement.
They do.
Yet, according to a recent SUBI study, 9 out of 10 individual traders in the equity F&O segment incur net losses. We need to understand the mechanics that govern this paradox.
That tension between perfect market structure and, individual failure is the key to mastering this chapter.
Okay, so how are we structuring this?
To structure our learning, we have 5 mandatory areas we must cover. Definitions and core concepts, a detailed analysis of the 4 product types.
Okay.
Dissection of the rigorous trading and settlement rules, mastery of the risk management framework, and finally, weighing the applications, benefits, and inherent costs.
Let's not waste a second.
Let's start at the absolute foundation.
The first step is the precise definition. How does the NISM material define this financial instrument?
The definition is simple, yet crucial. A derivative refers to a financial product whose value is derived from another product. It never stands alone.
It's tethered.
Completely tethered. Its price movement is entirely tied to that other product, which we call the underlying. Without an underlying asset, there is no derivative.
So the underlying is the source of the original risk. If we are trading a contract based on the price of Brent crude oil?
The oil itself is the underlying.
Right. And if it's an interest rate derivative?
Then the underlying is the benchmark interest rate, perhaps the MIBOR, the Mumbai Interbank Offer Rate. The underlying is absolutely critical.
Why so critical?
Because the underlying is subject to the risk being managed. The primary utility of derivatives, and this is straight from Section 6.1.1, is pure risk management.
Okay.
Imagine you are a large corporate entity. Your entire revenue stream depends on selling products abroad.
You're exposed to exchange rate risk.
You are totally exposed. The underlying asset, the currency pair it, fluctuates.
Yeah.
And that creates uncertainty about your future profitability.
That immediately introduces the classic derivative dynamic, right?
Right.
Opposing risks.
Yes.
If I am an Indian importer paying in US dollars, I worry about the rupee depreciating.
Meaning you pay more rupees later.
And if I am an Indian exporter receiving US dollars, I worry about the rupee appreciating.
Meaning you receive fewer rupees later.
Yeah.
Exactly. You both face the risk of an unknown future value.
And that's where the contract is born.
This is the moment. When the importer and the exporter enter into a derivative contract, they become counterparties.
Okay.
By fixing the price today for a future transaction, they transfer the unwanted risk to the other party. They achieve certainty in an uncertain future.
And that transfer is what financial engineering is all about.
That's the whole game.
So to understand how this risk transfer actually works, we need to analyze the simplest and oldest form of derivative, the forward contract.
A forward contract is precisely defined as a derivative contract, where 2 parties agree to exchange a specific good at a specific price on a specific date in the future.
And these are tailor-made?
Critically, yes. These are tailor-made contracts. The terms are mutually agreed upon, which immediately flags a risk we'll discuss later.
Let's use the classic commodity example gold to analyze the 3 possible payoff scenarios. This seems vital for grasping the zero-sum nature.
It is.
So suppose a jewelry buyer needs 10 grams of gold in 1 year. They agree with the gold mining seller today to transact at 30,000 rupees per 10 grams.
The agreed-upon price, 30,000 rupees, is locked in. Now let's dissect the market movements.
Okay, scenario 1.
Scenario A, market price unchanged. 1 year later, the open market price, the spot price, is still 30,000.
So nothing happens, really.
They transact at the agreed price. Neither party has lost or gained relative to the spot market. The contract served its purpose of fixing the price, but there was no transfer of wealth.
Right. Scenario B, market price rises. 1 year later, the market price jumps to $35,000
Here, the buyer gains significantly.
because they're only paying $30,000.
They are contractually obligated to pay only $30,000 for something currently worth $35,000. The seller, conversely, loses 5,000 rupees.
Because they could have sold it for more on the open market.
They could have sold it for 35,000. The buyer's gain of 5,000 rupees precisely equals the seller's loss of 5,000 rupees.
Okay. So, scenario C, market price falls. 1 year later, the market price drops to $25,000.
The roles are reversed. The seller gains because they receive 30,000, which is 5,000 higher than the current spot price.
And the buyer loses.
The buyer loses, paying 5,000 more than they would have in the open market. This detailed analysis proves the fundamental concept in a forward contract. The payoff structure is symmetrical.
It's a clear zero-sum game.
A perfect zero-sum game. The risk is merely transferred, it is not eliminated.
That symmetry is key, but the source material emphasizes that derivatives are defined by structured payoffs.
They are.
So the primary objective is to transfer risk, but the modern market allows that transfer to be highly customized.
Indeed. While forwards have symmetrical risk, products like options introduce asymmetrical payoffs. But whether symmetrical or asymmetrical, the function is the same.
To transfer risk.
To transfer risk arising from variability in the underlying's value. To appreciate the sheer scope, let's go deeper into the 4 examples provided. They show how risk is structurally separated from the original activity.
Okay, first up, the weather derivative. This moves us away from purely financial or physical assets?
Correct. The underlying here is a non-financial metric. It could be the amount of rainfall, temperature, or wind speed.
So for a farmer.
For a farmer, the risk is crop loss due to drought or flooding. They don't want to manage weather risk, they want to farm.
So they can offload that risk.
They can transfer that meteorological risk to an insurance provider or a speculator via a derivative contract. The payoff is structured to pay out a specific amount if rainfall falls below a predetermined threshold.
Decoupling farming profits from weather volatility.
Exactly.
Next, the crucial banking and corporate tool, the interest rate swap. This is technically complex, so we probably need a step-by-step breakdown.
This is critical, yes. Imagine a corporate borrower who takes out a loan tied to a floating interest rate, say, the 3-month T-bill rate plus 200 basis points.
That volatility in payments makes budgeting difficult.
Very difficult. They want a fixed interest rate. To achieve this, they enter a swap with a dealer, the counterparty.
So they now have 2 simultaneous obligations, correct? The original floating rate loan and this new swap contract.
Precisely. In the swap, they agree to 2 legs. Leg 1, the payment. The borrower pays the swap dealer a fixed interest rate based on the notional principal amount.
Okay.
Leg 2, the receipt. The borrower receives the floating interest rate, that T-bill plus 200 basis points, from the swap dealer.
Ah, I see the financial engineering. The money they receive in leg 2 exactly matches the variable interest payment they owe on their original loan.
Yes, the floating rate cash flows cancel each other out.
So what's left?
The net result is that the only interest payment remaining is the fixed rate they pay to the swap dealer. They have successfully converted their volatile, floating rate obligation into a steady, fixed rate obligation.
All without having to renegotiate the original loan.
That's the power of it. It's a powerful demonstration of risk restructuring.
Third, the currency derivative, which we touched on briefly.
Essential for global commerce. If an Indian importer must pay a vendor 100,000 euros in 6 months,
They face the risk that the rupee will weaken against the euro.
right, that the exchange rate will move unfavorably, making the euro more expensive. So they enter a currency future, or forward today, to fix the price of the euro in terms of rupees.
Transferring the risk.
The risk of rupee depreciation, the underlying currency fluctuation, is transferred to the counterparty, perhaps a bank or a speculator.
And finally, what makes up the vast majority of exchange volume in India? The index derivative.
Yes. If a large institutional portfolio manager holds a diverse portfolio of, say, 100 stocks, they face systemic risk.
The risk that the entire market collapses.
The risk that the whole market, represented by the Nifty 50 or Sensex, goes down. Instead of selling 100 different stocks to hedge this risk, which is cumbersome and expensive,
They can just sell one thing.
they can sell a single index future. If the market falls, The loss in their portfolio is offset by the gain in their short index futures position.
Just efficient.
Incredibly efficient. It hedges market fall risk across the entire portfolio. This efficiency is why index derivatives are so popular.
That comprehensive view sets the stage. Let's move now to the conceptual truths that govern this market, starting again with the zero-sum game in futures. Why is it so crucial that NISM exam takers internalize this?
Because it fundamentally defines what derivatives are and what they are not. We established that counterparties have opposing views.
Right. Seller expects a price fall, buyer expects a price rise.
Yes. The key NISM point here is that the net economic value of all derivative positions by definition should be zero.
Meaning they don't create new wealth.
They are not capital formation instruments. They are wealth distribution instruments. They do not create new assets. They merely transfer existing risk and wealth among participants. If a position nets 100 rupees profit, someone else must have taken 100 rupees loss.
Okay. Next, we must clarify the two forms of closing out a position: cash and physical settlement.
Cash settlement means that upon expiration or exercise, the counterparties settle their position through the exchange of price differentials in cash.
So no actual delivery of the asset.
No physical delivery at all. For example, if your futures contract expires and you were due a 5,000 rupee profit, that 5,000 rupees is simply credited to your account. This is the mandated mechanism for index futures and index options globally and in India.
But the regulatory landscape for individual stocks is different, and this reflects a key policy choice by SEBI.
This is a critical distinction for the exam. The norm in India has shifted. Since October 2019, SEBI mandated physical settlement for all derivatives on individual securities.
So stock futures and stock options.
That's right. This means if an open position on, say, Reliance stock futures remains open on the last Thursday of the month, the short party must deliver the actual shares.
And the long party must take delivery and pay the full contract value.
Yes.
Why did SEBI enforce this? What was the regulatory motivation behind physical settlement for individual stocks?
The primary goal was to temper excessive speculation. When settlement is cash-based, traders often treat derivatives purely as a betting mechanism,
Right.
leveraging huge positions they could never afford to actually own. By mandating physical delivery, traders must now have the capacity to handle or pay for the underlying stock upon expiry,
Which theoretically reduces that rampant speculative activity.
and better aligns the derivative price with the spot price in the days leading up to expiry.
Let's link the structure of the product to the venue. We saw that forwards are prone to a major risk because they are OTC.
OTC, over-the-counter, refers to non-standardized contracts negotiated directly and mutually between two parties.
And since there is no intermediary,
There's no intermediary guaranteeing the trade, so they are fraught with counterparty risk.
the risk that the other side just fails to pay up.
The risk that one party fails to honor its side of the bargain. This risk exploded during the 2008 financial crisis with certain OTC products. Forwards and most swaps operate in this risk-heavy environment, typically between large institutions who vet each other's creditworthiness.
So the fundamental innovation of the exchange-traded derivative was to eliminate that counterparty risk entirely. How is that achieved?
By mandating standardization and introducing the Clearing Corporation, or CC.
Okay.
Exchange-traded derivatives, like futures and exchange-traded options, have contracts specified entirely by the exchange. When you execute a trade, the Clearing Corporation steps in between the buyer and the seller.
Becoming the counterparty to everyone.
It acts as the counterparty to every trade. It essentially guarantees that the seller gets paid and the buyer receives their asset or cash flow, regardless of whether the original counterparty defaults.
And that's achieved through the rigorous margin system we'll detail later.
Precisely.
This structure leads us directly to the concept of arbitrage, which ensures market sanity.
It does.
Arbitrage is the mechanism that keeps the derivative price aligned with the cash market price, starting with the law of one price.
That law is the bedrock of finance. Identical goods cannot trade at different prices in two markets simultaneously after accounting for transaction costs.
So if a nifty spot price implies a certain future value,
And the nifty future trades significantly above or below that implied value, a riskless profit opportunity exists.
and the market participants who enforce this are the arbitrageurs.
Yes, they are specialists who continuously scan the cash market and the derivative market for even tiny price discrepancies.
So what do they do?
If the nifty future is overpriced compared to the nifty index spot price, the arbitrageur executes two simultaneous trades. They sell the overpriced future and buy the underlying basket of stocks in the cash market.
Locking in both sides.
By locking in both sides, they guarantee a riskless profit upon expiry, because at expiry, the future price must equal the spot price.
But if arbitrage is riskless, why doesn't everyone do it and wipe out the profit instantly? What determines the precise difference between the future price and the spot price?
That is the beautiful part of the equation. The price difference is determined mathematically by the cost of carry. Arbitrageurs ensure that the futures price equals the spot price plus the cost of carry.
And what elements make up that cost of carry?
The cost of carry includes all transaction costs and holding costs until the future settlement date. For commodities, this involves physical costs, like warehousing, transportation, and insurance.
Right.
But crucially, for financial assets like stocks or indices, the primary element is the interest cost.
The cost of money.
The interest they lose by having to pay cash today to buy the underlying assets, or the interest they might gain if the underlying asset pays dividends. Arbitrageurs ensure the price gap reflects only these unavoidable costs, thereby keeping the market efficient.
We now move to the specific mechanics of the four derivative products that dominate the NISM syllabus. First, forwards.
To reiterate, forwards are the oldest type. Key features. They are OTC, which means high counterparty risk. They are non-standard, meaning the quantity, quality, and settlement terms are custom-tailored to the two parties involved.
The example often cited is the traditional agricultural forward trade between a mill and a farmer, a relationship based on mutual trust.
Exactly. Because there is no exchange guarantee. They rely on reputation and legal enforcement, not a central clearinghouse. While essential for customized risk management, this lack of standardization makes them inherently riskier and less transparent.
Then their exchange-traded cousins, the futures.
Precisely. Futures fundamentally solve the transparency and counterparty risk problems of forwards. They're often called exchange-traded forwards.
So what are their key features?
They are traded on a formal exchange, the terms are entirely standardized, and they are guaranteed by the clearing corporation.
Let's elaborate on what standardization means in practice using the hypothetical MCX wheat futures again.
Standardization means that the exchange specifies everything so that every single contract is fungible or interchangeable.
So things like?
This includes the precise trading unit, say 10 metric tons, the specific quality required for delivery, the delivery location, for example, specific accredited warehouses, and the expiry date. This removes all ambiguity.
Allowing for anonymous liquid trading.
Yes. Without standardization, the clearing corporation couldn't efficiently manage the risk and assign obligations.
And the mechanism that killed the counterparty risk.
We must repeat this. The clearing corporation steps in as the legal counterparty to every trade. It guarantees payment to the buyer and delivery to the seller.
How?
By ensuring that both the buyer and the seller must deposit collateral margins up front. This collateralization allows for anonymous trading, which is vital for liquidity.
Now, options. These introduce an asymmetric payoff structure and a concept unique to derivatives.
Yes, the distinction between a right and an obligation.
So what's the definition?
An option is a contract giving the buyer the right, but not the obligation, to buy or sell the underlying asset at a stated price on or before a stated date for an upfront fee called the premium.
The lack of obligation is the core difference from futures.
Absolutely.
Yeah.
In futures, both parties are obligated. Here, only one is.
Let's use the formal terminology, starting with the two basic positions.
The buyer, or holder, takes a long position. They pay the premium and acquire the right. Their risk is limited to that premium.
And the seller.
The seller, or writer, takes a short position. They receive the premium, but assume the obligation if the buyer chooses to exercise. Their risk is potentially unlimited, which is why they are subject to heavy margin requirements.
And the two types of rights.
The call option grants the buyer the right to buy the underlying asset at the fixed price. They profit if the market price rises above that fixed price.
And the put option.
The put option grants the buyer the right to sell the underlying asset at the fixed price. They profit if the market price falls below that fixed price.
Now, let's define the three critical pieces of terminology that define the contract itself.
First, the strike price, or exercise price. This is the predetermined price at which the transaction may occur.
Okay.
Second, the option premium. This is the non-refundable upfront cost paid by the buyer to the seller. It represents the option's value and the buyer's maximum possible loss.
And third.
Third, the expiration date, the final date on which the right may be exercised.
Using the nifty example, Arvind buys a call option from Salim with a strike price of 10,000 rupees, paying a 100 rupee premium. Let's analyze the asymmetric payoff. What if the Nifty rises to 10,200?
This is a favorable move. The option is in the money.
So Arvind exercises.
Arvind exercises his right to buy at 10,000 when the market is at 10,200. He gains 200 rupees minus the 100 rupee premium cost, netting a 100 rupee profit.
And Salim, the writer?
Salim is obligated to sell at 10,000. He loses 200 rupees, but he offsets this with the 100 rupee premium he received, so he has a net loss of 100 rupees.
And what if the Nifty falls to 9,800?
The option is out of the money. Arvind simply lets the contract expire worthless.
So he just loses the premium.
He loses nothing more than the 100 rupee premium he paid. Salim, the writer, keeps the 100 rupee premium and has no further obligation. He profits by the premium amount.
So the buyer has limited loss and the seller has limited gain but potentially unlimited loss.
That structural difference is what makes options such a unique tool.
Finally, we turn to swaps, contracts that focus on exchanging future cash flows.
Yes, these are primarily used in institutional and corporate finance. A swap is a complex, customized contract where two parties agree to exchange specified future cash flows. They are typically OTC.
Let's revisit the interest rate swap with surgical detail because this operational complexity is often tested.
It is. We had the borrower paying a floating rate, the T-bill plus spread, who wants to fix their cost.
Right.
So we have two counterparties. The fixed rate payer, our borrower, and the floating rate payer, usually a financial institution or swap dealer. The borrower agrees to pay the dealer a fixed percentage on a set notional principal every quarter.
And in return?
In return, the dealer pays the borrower the floating rate, that T-bill plus spread.
The dealer often enters this to manage a mismatch on their own books, right? An asset-liability duration mismatch.
Precisely. The dealer might have long-term fixed-rate liabilities and needs short-term floating-rate assets to balance their books. By accepting the fixed payment and paying the floating payment, the dealer essentially assumes the borrower's floating rate risk.
And for the borrower, the two floating legs?
The one they owe on their loan and the one they receive from the dealer, they cancel out, isolating the fixed rate as their sole remaining cash outflow. Swaps are customized but often governed by international dealer associations to maintain some degree of enforceability.
Okay, let's anchor this theory in the Indian market reality. We need to list the key products traded on our exchanges.
The key instruments traded are equity index futures and options, individual stock futures and options, currency futures and options on pairs like USD-INR,
Right.
interest rate futures and options, and various commodity futures and options. It's a very wide spectrum.
And structurally, we must recall the unique feature you mentioned, India's prominence in individual stock F&O.
That's a key historical point. The market launched index futures in June 2000 and followed quickly with individual stock futures and options in 2001. Few developed markets globally permit this extensive trading of individual stock futures.
And that leads to unique volatility.
It does. And as the SEBI data shows, significant challenges for individual traders. The overall volume in our equity derivative segment regularly dwarfs the volume in the underlying cash equity market.
Which is a testament to the scale of leveraging and speculation that occurs here.
Absolutely.
The trading itself is entirely screen-based, national, and fully automated. But not every stock gets a derivative contract. What criteria must they meet?
The selection criteria are stringent and set by SEBI, with exchanges often imposing even tighter limits. The primary focus is guaranteeing liquidity.
And how is that liquidity measured?
We look at two main metrics. First, size, measured by market capitalization and turnover velocity. The stock must be one of the largest and most actively traded companies.
Okay, and second?
Second, trading volume, measured by the sheer number of shares traded daily. The purpose is to ensure that there is always a buyer and a seller near the prevailing price.
To prevent price manipulation and ensure efficient price discovery.
Exactly. Only if the stock meets these high thresholds is it permitted to have an F&O contract listed.
Now for the exam-critical specifics. Let's nail down the precise technical specifications of an equity futures contract, starting with the expiry date.
Regulatory norm. All standard monthly contracts expire on the last Thursday of every calendar month.
And if that's a holiday?
If that Thursday happens to be a trading holiday, the contract automatically expires on the preceding trading day. This is an absolute rule you need to know.
And the trading cycle. How many contracts can I trade at any point?
Standard practice dictates 3 cycles available at any time. The near month, which is the current month, the next T month, and the far month.
And when the near month expires?
When the near month expires on that last Thursday, the contract for the fourth month rolls in. While most trading focuses on the near month, the exchange also specifies long maturity contracts aligned with the March, June, September, and December cycles.
Plus the weekly options.
And of course, we now have weekly index options, providing even finer granularity for hedging or speculation.
Let's discuss the financial threshold, the trading lot. This is a mandated numerical requirement.
This number is critical for the exam. The trading lot for a contract at the time of its introduction must be specified such that the value of the lot is not less than 5 lakh rupees.
Why so high?
This ensures that derivative trading remains a domain requiring substantial capital depth per unit, minimizing the participation of very small retail traders and enhancing market stability.
And the smallest permissible movement in price, the tick size.
The smallest movement, or price step for equity derivatives, is fixed at 5 paisa, rate 0.05. All trades must be executed in multiples of 5 pieces.
Finally, we must mention how exchanges prevent obvious errors from causing market panic.
Through price and quantity freeze limits, the exchange sets dynamic price movement ranges. If an order attempts to execute outside this range, or if the quantity is unusually large, the order is instantly frozen.
And then what?
The trading member must then manually confirm to the exchange that the order was intended, effectively preventing system destabilization from typographical or fat finger errors.
Let's walk through the trading day. Regulatory timings are standardized.
The standard market timings are Monday to Friday from 9:15 a.m. to 3:30 p.m., same as the cash market. Orders can generally be modified until 4 p.m.
We need to clearly differentiate the order types traders use to manage execution risk.
We have the basic regular lot orders market, which is executed immediately, and limit, which is executed only at a specified price or better.
And then orders that manage the duration.
Right. A day order is canceled if it isn't matched by the end of the trading session. An immediate or cancel, or IOC, order is canceled instantly if it cannot be executed right away.
And the essential risk management orders.
The stop-loss order is crucial. It remains dormant until the market price reaches a predetermined trigger price, at which point it converts into a market or limit order to sell or buy.
To protect against adverse movement.
Exactly. And finally, the spread order allows a trader to simultaneously manage positions in 2 different contracts, say a near month and a far month future, executing only when the difference in their prices reaches a desired level.
A major logistical challenge is the adjustment required for corporate actions. How does the exchange ensure the value of a derivative position is preserved when a stock issues a bonus or a split?
The core principle is value preservation. When a bonus issue, stock split, or rights issue occurs, the exchange must adjust the derivative contract's specifications.
The strike price and the market lot.
Correct. So that the financial value of the derivative position before the action is mathematically identical to the value after the action. This adjustment is carried out after market close on the come date.
For instance, in a 2-for-1 stock split.
The strike price is usually halved and the lot size is doubled.
We know the clearing corporation guarantees settlement, but they interact with the trading world through clearing members. Let's define the 3 critical types.
First, the trading member clearing member, or TMCM. This entity is authorized to execute trades on the exchange and clear and settle those trades for themselves and for others.
Okay.
Second, the professional clearing member, or PCM. This is an institution, often a large custodian or bank, that clears and settles trades only for others. They do not trade themselves.
They're a purely settlement facilitator.
Purely. Third, the self-clearing member, or SCM. This is a member that trades and clears and settles, but only their own trades. They don't clear for any other client or member.
The actual settlement happens daily. Let's delve into the mechanics of the daily settlement, or mark-to-market.
All derivative contracts are mark-to-market and settled on a T+1 basis, the day after the trade.
And the calculation requires a special price.
It requires the daily settlement price, the DSP, and this is a crucial detail. The DSP is announced by the exchange and is calculated as the weighted average price of the last 30 minutes of trading for that specific contract.
Why the weighted average of the last 30 minutes? Why not simply the closing price?
It's a mechanism to prevent manipulation. Using a weighted average across a 30-minute window makes it significantly harder for a single large trade executed right at the close to artificially skew the settlement price.
Which would affect the margins and pay-in, payout obligations of every member.
Yes, the DSP is designed to reflect a fair, representative market price.
Let's revisit the example to ensure we grasp the T+1 pay-in obligation. Say a nifty futures contract with a lot size of 50 was bought at 10,000. The DSP at 3:30 p.m. is 9,900.
The loss in the position is 100 rupees per contract. Total loss exposure is 50 times 100, totaling 5,000 rupees.
And this becomes the pay-in obligation.
This 5,000 rupees becomes the purchaser's pay-in obligation. They must pay this amount to their clearing member, who in turn pays the clearing corporation, which then pays the 5,000 rupee profit to the counterparty.
And this must happen the next day.
It must happen before the stipulated time the next day, on T+1, ensuring that potential losses are squared off daily and do not accumulate.
This leads to the final settlement on the expiry date.
The mechanism remains mark-to-market, but the price used for final settlement is different. All remaining open positions are closed using the closing price of the relevant underlying index or security in the cash market on the expiry day.
And for stock futures, this closing price dictates the price for the physical delivery.
Correct.
And all this rigorous cash flow management requires dedicated bank accounts.
Absolutely. Clearing members must open specific clearing accounts with designated clearing banks. These banks are impaneled by the clearing corporation, and the accounts must be used exclusively for settlement purposes.
Options have some unique settlement features, often tested against the simpler futures mechanics. Let's start with the exercise style.
We must define the two types. The American option can be exercised by the buyer anytime up to and including the expiry date.
Okay.
The European option can be exercised only on the expiry date. Crucially, in the Indian market, we trade European-style index and stock options.
Designated as CE and PE.
CE for Call European and PE for Put European.
The pricing mechanism is also distinct from futures.
Yes, the contract specifies the fixed strike price, but the market mechanism determines the premium. Like futures, the minimum price step, or tick size, for options is 5 paisa.
How does the mark-to-market process apply here?
This is a major point of difference from futures. In options, daily settlement is only for the premium amount and is settled T+1.
So the buyer pays the premium the next day.
Correct. The full notional value of the option is not mark-to-market daily because the buyer's maximum loss is fixed at the premium. The MTM process on the notional value only applies to the option seller via margin requirements.
Because of their unlimited risk exposure?
Exactly.
And the final settlement on the last Thursday.
On expiry, only those options that are in the money are settled. If a call option's strike price is 10,000 and the market closes at 10,100, that option is in the money and is settled.
At the difference between the strike and the closing price.
Yes. The clearing corporation manages the process of aggregating the long exercising positions and assigning them proportionally to the short obligated positions.
This entire sophisticated structure only works because the clearing corporation's guarantee is watertight. We need to focus on the 5 pillars of the risk management framework that prevents systemic collapse.
The 5 pillars are capital adequacy, stringent margin requirements, position limits, online monitoring, and automatic disablement of trading terminals upon breach.
Each element designed to minimize the likelihood of a settlement failure.
Correct.
So, capital adequacy. What resources must a clearing member have available?
The exchange and clearing corporation enforce minimum requirements for base capital and liquid net worth. Liquid net worth is the critical component here.
Meaning what?
It must consist of easily convertible assets like cash, cash equivalents, bank guarantees, or approved securities.
And how is this the ultimate safety net?
If a clearing member fails to meet their obligations, the clearing corporation is authorized to utilize this liquid net worth to cover the shortfall. By maintaining these strict capital standards, the clearing corporation effectively buffers the system against individual member defaults.
Which allows them to guarantee all trades?
That's how the guarantee works.
Now, margins, the upfront collateral, the first line of defense. Let's differentiate the 2 main margins collected in the futures market.
First, the initial margin. This is the security deposit collected to cover potential losses over a 2-day risk horizon, computed using a dynamic, sophisticated value at risk, or VALNS methodology.
It captures volatility risk.
It does. Second, the exposure margin. This is a fixed percentage collected over and above the initial margin, based on the notional value of the open position. It acts as an additional layer of protection.
Against unexpected, massive price shocks.
The kind that might exceed the VAR estimates.
Both are payable in advance, which is a major regulatory focus.
Absolutely. The NISM source material highlights the circular from SEBI in July 2020, mandating the precise verification of the upfront collection of margins from clients.
So the broker has to prove the client paid before the trade.
They have to prove that the client has deposited the required margin amount before the trade is executed. This ensures the risk is collateralized at the grassroots level.
How does this margin calculation change for options?
The philosophy is driven by the risk asymmetry. Initial margins are still levied on the total premium value of open options positions.
But the critical difference is the exposure margin.
Exactly. Since the buyer's loss is limited to the premium, they do not need exposure margin on the notional contract value. The exposure margin is levied only on short option positions.
On the sellers, because they bear the unlimited potential loss.
And the obligation to honor the contract.
And the two specific margins for option settlement.
The premium margin is the amount of the premium owed by the buyer until the payment is completed, and the assignment margin is collected from the seller to cover their settlement obligation for assigned in-the-money options.
Beyond capital, the exchange needs controls to ensure no single player dominates the market, creating a concentration risk. That's the function of position limits.
Position limits prevent systemic concentration risk. They ensure that no individual client or member can accumulate an open position that is so large that a sudden adverse market movement could threaten their ability to settle.
Potentially triggering a wider default.
That's the fear.
How are these limits quantified?
They are defined in two ways, either as a percentage of the overall market-wide open interest in that contract or in terms of the notional contract value, and they're monitored in real time.
What is the enforcement mechanism if a limit is breached?
The exchange's monitoring system sends immediate alerts. If the position purchased the limit, the member is typically disallowed from taking any fresh positions.
They can only square off.
They are only permitted to execute trades that square off or reduce their current exposure. If the breach is severe or repeated, the trading terminal can be automatically inactivated and financial penalties are imposed.
Having covered the mechanics, let's look at why market participants use these complex instruments. We have three distinct applications:
Hedging, speculation, and arbitrage.
Define hedging once more, focusing on the motivation.
Hedging is the strategic use of derivatives to protect an existing open position in the underlying cash market against future price risk. The hedger wants to reduce risk, not profit from price movement.
So a farmer with corn to sell.
They sell corn futures today to lock in a minimum price. They transfer the risk of price fluctuation to someone else, the speculator.
And speculation is the opposite philosophy.
Correct. Speculation is taking a calculated view on future prices without having an underlying cash position to protect. Speculators are actively seeking profit by assuming risk.
And their motivation is leverage.
It's the leverage afforded by derivatives. They only need to post the margin to control a large position. This high leverage is the source of the immense profits and the catastrophic losses.
At arbitrage.
Arbitrage is the riskless exploitation of mispricing. The arbitrager identifies a situation where the future price deviates from the theoretical spot price plus the cost of carry.
Buy cheap, sell expensive.
They simultaneously buy the cheap asset and sell the expensive contract, or vice versa, guaranteeing a profit irrespective of the final price movement. They are the market's efficiency police.
The benefits of a well-functioning derivative market are clear: superior risk management, enhanced liquidity, and improved price discovery.
Yes, the futures price instantly incorporates expectations about interest rates, storage costs, and future supply and demand.
But the costs and risks.
The costs and risks, particularly in the OTC space, have been historically immense, leading to liquidity crises and institutional failures. But the most immediate and profound cost, especially for our NISM-focused listener, relates to individual trading discipline.
This is where we bring back that powerful data point from SEBI.
This cannot be stressed enough. The SEBI study published on January 25, 2023, meticulously tracked the profitability of individual traders. It found that a staggering 9 out of 10 individual traders in the equity F&O segment incurred net losses
9 out of 10.
over the survey period. Furthermore, those losses were massive, amounting to thousands of crores of rupees in aggregate. This statistic is the ultimate illustration that market mechanics and individual outcomes are fundamentally separate challenges.
Let's wrap up by looking at how professionals read market sentiment using two key indicators: open interest and the put-call ratio.
Open interest, or OI, is defined as the sum of all incomplete or outstanding contracts in the market, represented as one-sided positions. When a contract is opened, a new long and a new short are created. OI increases by 1.
We need to be crystal clear on the difference between closing a position individually and the market OI remaining constant.
Imagine trader A sells a future to trader B. OI is 1. Later, trader A wants out, so they buy back the contract from trader C.
So trader A is flat.
Trader A has squared off their personal position. But the market still has one outstanding contract. Trader C is now long, Trader B is still short. The contract merely transferred counterparties. OI only falls when an existing long squares off with an existing short.
How is OI interpreted?
OI is a measure of liquidity and market conviction. A large OI relative to traded volume indicates high liquidity. If OI rises alongside rising prices, it signals that fresh money is entering the contract to push prices higher, a strong bullish confirmation.
And if prices fall while OI rises?
It suggests fresh money is shorting the contract, confirming a bearish trend.
The second indicator is the put-call ratio, or PCR.
The PCR is a simple fraction. It's the number of put options outstanding divided by the number of call options outstanding. It's a measure of market positioning and, implicitly, sentiment.
And the common interpretations.
If the PCR is less than 1, say 0.7, it means there are significantly more outstanding call options than put options.
So, bullish sentiment.
Often interpreted as bullish sentiment. But highly skewed ratios, a very low PCR, can sometimes indicate an overbought market. Too many people are bullish.
Suggesting a potential reversal.
Yes. Conversely, if the PCR is significantly greater than 1, say 1.3, there are far more outstanding puts than calls. Traders are buying the right to sell.
Which is often seen as bearish.
Often interpreted as a bearish signal, or sometimes heavy institutional hedging activity. Professional traders often use PCR as a counter indicator when it reaches extreme levels.
We have completed our comprehensive deep dive into the derivatives chapter.
Yes, we have. Remember the core NISM regulatory mandates. The mandatory physical settlement for individual stock F&O since 2019. The T+1 mark-to-market settlement based on the weighted average of the last 30 minutes.
Right.
The 5 lakh rupee minimum lot value and the 5 paisa tick size. These technical details are non-negotiable for passing the exam. You must know the mechanics that guarantee the trade.
And that guarantee, provided by the clearing corporation through stringent margins, capital adequacy, and position limits, is proof of the market's structural integrity.
It is.
Yet, we end where we began, with the sobering SEBI finding that 9 out of 10 individual traders ultimately lose money in this very system.
A difficult truth.
So, we leave you with this final, critical thought to reflect on as you continue your study of financial markets. The derivative structure is perfectly engineered to manage systemic risk, ensuring the exchange does not fail and every trade is honored. But what does the massive individual loss rate, the 90% who fail, tell you about the necessary differences between systemic risk management and speculative risk management? How does one transition from understanding the exchange's mechanics to mastering the individual discipline required to survive in a leveraged, zero-sum environment?
That is the real question.
That answer is the true mastery required for long-term success. You've got this. We'll see you on the next deep dive.